Okay, let's get straight into it. Bitcoin's showing some serious strength lately, hasn't it? Hovering around, what, $84,000, maybe $84,500?
Yeah, it's looking strong. And what really caught my eye was that bounce off the 50-week moving average. That's a pretty significant positive signal.
A real technical floor, right? Buyers stepping in.
Exactly. It shows there's solid support there, underlying momentum.
But today, we're actually looking beyond the charts, aren't we? We're diving into something potentially, well, game-changing, these signals from the Federal Reserve.
It really could be a major shift.
It almost feels like the opposite of, late 2021 when they announced the tightening, a potential pivot point.
That's a really good way to put it. What the Fed says or even hints at just echoes through every market, Bitcoin included, obviously. That 2021 tightening announcement certainly changed the weather.
So that's our mission for this deep dive, right? Understand what the Fed's really signaling, what it could mean, especially for Bitcoin and the wider financial world. We've looked at a bunch of analysis, market commentary.
Yep, trying to piece it all together.
Okay, so let's unpack it. What exactly did the Fed say or not say that's got everyone buzzing?
Well, the key thing is they've indicated they're ready to step in if bond yields keep going up. It seems like it's a reaction to market skepticism about the administration's financial plans.
Like that Trump art of the deal vibe, uncertainty about the long game.
Sort of, yeah. A lack of perceived clarity or maybe stability, and that feeds into the bond market.
Right, and we saw that in the 20-year Treasury yield. Someone called it a massive candle to the upside. For folks not glued to bond charts, why is that such a big deal?
Okay, so that massive candle, it basically means a huge sell-off of U.S. government bonds. When lots of people sell bonds, the price drops, and the interest rate you get goes up.
Because it's riskier, so you demand a higher return.
Exactly. So a sharp jump like that in the 20-year suggests, serious concern about the long-term health of U.S. finances. People are less willing to hold that debt unless they get paid more for the risk.
And this isn't just a U.S. thing, is it? These yields ripple outwards.
Oh, absolutely. The 10-year Treasury yield especially is like a global benchmark. Lots of international loans and financial deals are priced off it.
So if that goes haywire,
it tightens credit everywhere. Makes borrowing more expensive for companies all around the world. It injects instability.
Okay, so the Fed hinting they might step in is about calming things down. And it's the first time they've hinted at this since the whole tightening cycle began.
That's what's really significant. Since they started hiking rates back in 2021, it's all been about fighting inflation, tightening the belt. Now, suggesting they might intervene, maybe buy bonds, potentially inject liquidity, maybe even, print money.
Which is the opposite of tightening.
It's the opposite. It suggests their priorities might be shifting, maybe towards stabilizing the debt market itself.
So thinking back to late 21, that tightening signal basically called time on the bull market for a lot of stuff. Could this be the reverse, a green light for risk assets?
It definitely opens that door. If the Fed actively pushes yields down, that means more liquidity, which could support asset prices. Stocks, Bitcoin. It's plausible. Given how the market reacted last time, this potential U-turn is something everyone's watching.
Though the source did say the Fed mentioned they don't see immediate liquidity problems right now, but they're watching yields closely this week. Sounds like walking a tightrope.
That's a perfect description. They're acknowledging the market's jitters without actually, hitting the panic button yet. It's a warning shot. Saying, we'll step in if yields keep rising this week, puts everyone on notice.
And then there's the whole tariff situation adding to the mix. Electronics tariffs, maybe on, maybe off.
Yeah.
How does that chaos factor in?
Well, that kind of policy whiplash just creates massive uncertainty. Businesses can't plan. It can fuel inflation fears, too. All that instability can just add fuel to the bond sell-off fire the Fed's worried about.
Okay, so connecting the dots. This tariff stuff might actually force the Fed's hand faster, push them towards intervention, maybe even that printing scenario.
That's the arguments that we're making, yeah. Tariffs can slow the economy, create friction. If things look shaky, the Fed might feel they have to loosen policy, stimulate things, and often that involves increasing the money supply electronically.
Which brings us back to the idea of fiat devaluation. The more dollars, euros, whatever get created,
the less each one is potentially worth over time.
Yeah.
And that leads to that, more extreme view we saw, that this just accelerates the path where all fiat eventually goes to zero.
And Bitcoin, with its fixed supply,
becomes the alternative. The argument goes Bitcoin goes to infinity in fiat terms because the fiat denominator keeps shrinking. It's that hard money thesis.
Interesting. Now, speaking of money creation, we saw a big slug of Tether USDT get printed recently, $1 billion worth. That seemed different from recent months where it was more USDC. Any significance there?
It could mean a few things. Maybe increased demand for trading within the crypto space, or people moving funds around. $1 billion USDT is definitely noticeable. Sometimes big stablecoin minting like that precedes more volatility or activity in Bitcoin and other cryptos. Worth keeping an eye on.
And then you've got Jamie Dimon at JP Morgan chiming in. He said the Fed will have to step in quickly because of a market kerfuffle in treasuries. Love that word.
Huh. Yeah, kerfuffle.
Yeah.
It certainly paints a picture of disorder, doesn't it?
Yeah.
He's basically saying this isn't just minor volatility, it's a real problem brewing that needs attention fast.
And he had a theory why this kerfuffle is happening, right? Blaming banking regulations for squeezing liquidity in the treasury market.
Yeah, his argument is that current rules might be stopping banks from easily acting as market makers, buying and selling treasuries smoothly, especially when things get stressed. So he suggests maybe loosening some of those regulations could help.
But the counter-argument was, maybe that's missing the bigger picture.
Yeah.
That it's not just regulations, but maybe declining global faith in the dollar itself.
That's a crucial counterpoint. You can tweak market rules, sure, but does that fix underlying worries about U.S. debt levels, fiscal policy, maybe geopolitical shifts? Those are much bigger fish to fry than just bank capital rules.
Okay, switching gears slightly. Robert Kiyosaki. He's back with his warnings, isn't he? Big stock and bond crash coming. Buy gold, silver, Bitcoin.
He is very consistent with that message.
Yeah.
Predicting crashes is tricky business timing-wise, but his core argument is always about the instability of the fiat system and the need for hard assets. Gold, silver, Bitcoin fit that thesis.
He also had that line about the US dollar being wiped out by a sinister global banking cartel. Pretty strong language.
Yeah, that definitely leans into a more conspiratorial view of finance, blaming central banks and global institutions. It resonates with some folks, but, it's important to consider the broader economic factors as well.
Now, this was interesting, the idea of the euro becoming the BTC of fiat currencies, because it's so bureaucratic and slow to change.
That's a fascinating take, isn't it? The idea is that the very bureaucracy and difficulty in making quick changes in the Eurozone actually creates a kind of stability or immutability compared to the US dollar, where policy can shift faster.
So less nimble, but maybe more predictable?
Potentially. It's seen by some as a sort of dependable anchor in the fiat world because it's hard to mess with quickly. The Swiss franc got to mention too. Classic safe haven, though a smaller economy, of course.
Okay, back to the Fed statement. This idea of it being a dog whistle, a subtle signal of future action.
I think that's a very likely interpretation. Markets hang on every word from the Fed. Saying they're ready to step in is like firing a warning flare. It's meant to soothe nerves, maybe change behavior, without actually doing anything yet. It signals their pain threshold for rising yields might be lower now.
And we saw markets react, didn't we? Despite tariff noise, Bitcoin futures, S&P futures, they were actually up. The market's already pricing in Fed help.
That could well be it. If the market thinks, okay, the Fed's got our back, they'll keep liquidity flowing if things get rough, then that can outweigh immediate worries like tariffs. Future policy expectations trumping present concerns.
It feels a bit like late 2021 again, but in reverse. They talked about rate hikes for months before they actually started in 22. So this "we're ready" signal now could mean actual intervention, down the road a bit.
Absolutely. Central banks often telegraph their punches. This could be laying the groundwork, setting expectations for if or when they feel they need to act. These shifts usually don't happen instantly.
Okay, let's zoom out a bit. Longer-term Bitcoin picture. We had Senator Loomis talking about needing a U.S. Bitcoin strategy to tackle the national debt. That's quite something coming from Capitol Hill.
It really is. Her specific proposal, buying, $200 of Bitcoin a year for 5 years, holding it for 20, potentially cutting the debt in half. It's ambitious, sure, but it shows Bitcoin is entering serious policy discussions as a potential national asset.
Even the idea of Bitcoin backing the dollar someday.
Yeah, that's still very theoretical, but just the fact it's being discussed signifies a potential paradigm shift in monetary thinking.
And then there's Michael Saylor, still incredibly bullish, calling Bitcoin the most powerful force, predicting it'll be the biggest asset globally in 4 years, maybe even replacing gold and causing issues for countries holding lots of gold.
Saylor's conviction is unwavering. His whole thesis rests on Bitcoin's unique properties: scarcity, decentralization, adoption network effects. The idea of it flipping gold is definitely bold, a long-term play.
Bitwise is also bullish, projecting $200,000 Bitcoin this year. And they linked it specifically to rising global money supply and potential rate cuts. Ties right back to this Fed pivot idea.
Exactly. If central banks ease up, pump more liquidity into the system globally, that's historically been good for assets like Bitcoin. Bitwise pointed out that lag, too. Bitcoin often seems to follow increases in global liquidity by a few months.
And it's interesting who's getting interested now. It's not just the usual crypto crowd. Liz Truss, former UK PM, saying Bitcoin could take power away from governments.
That's a significant shift in perspective from someone with that background. It highlights Bitcoin's appeal beyond just investment, the decentralization, the anti-establishment angle, and her mentioning the resistance she faced trying to make the UK crypto-friendly. It shows the friction with the old guard.
And CZ, Changpeng's out, now he's out. He's still talking long-term $1 million Bitcoin, but emphasizing it's about building the industry, like the early internet.
Right, he's managing expectations, saying this isn't overnight. His analogy to the early web and e-commerce, meaning infrastructure and time for adoption to really take hold, is pretty apt. He made a good point that serious, widespread adoption has really only kicked off in the last year and a half.
We're also seeing more companies follow MicroStrategy's lead, aren't we? Sailor hinting at more buys, Metaplanet in Japan adding more, even GameStop and Sol Strategies getting into Bitcoin accumulation.
It does seem like the Bitcoin on the balance sheet strategy is spreading. More public companies seeing it as a viable treasury reserve asset. It signals wider acceptance. And that example of ex-Kraken folks forming a Solana MicroStrategy, it shows the idea is even filtering into other crypto ecosystems.
Then we have Ray Dalio's perspective. He sounded pretty concerned, suggesting this might be worse than just a recession, maybe a breakdown of the whole monetary order, pointing to debt, tariffs, the rise of China.
Dalio brings that big macro historical view, comparing now to the 1930s, highlighting the combination of massive debt, trade conflicts like tariffs, and major power shifts globally. It's a heavy analysis.
And his conclusion, Bitcoin and gold are likely winners in that kind of upheaval.
Yeah, reinforcing that safe haven narrative. He sees them as assets that could hold value or even appreciate during a period of major financial system stress.
He even linked the tariffs directly to speeding up the end of the current fiat system, which ultimately benefits Bitcoin. A dark view for fiat, but potentially bright for BTC.
His point is that policies like tariffs, if they destabilize things further, could just accelerate the existing vulnerabilities in the debt-based fiat system, pushing people towards alternatives like Bitcoin faster. It's a systemic argument.
Interesting side note on the tariffs, the reactions in China. Some humor on TikTok, apparently, but also this trend of factories selling directly to consumers overseas, maybe dodging tariffs that way.
Yeah, it shows how adaptable global trade can be. If factories start marketing directly, using personal import allowances to bypass tariffs on larger shipments, that can really shake up traditional retail and supply chains. Globalization, finding new paths.
And just quickly looping back to CZ, those reports about his plea deal, the Wall Street Journal suggested he might have given info on others, mentioning Justin Sun, though Sun hasn't faced charges.
Right, it's still murky. These reports highlight the ongoing regulatory focus on crypto. The fact Sun hasn't been charged makes you wonder about the info, or maybe things are just moving slowly. It's complex.
And that rumor about CZ, Binance, maybe working with Trump on a stablecoin to get back into the US, wild times.
Very speculative, but it points to the constantly shifting political and regulatory landscape for crypto in the US. Anything seems possible right now.
Lastly, that Minentra token, OM. Big price drop, like 90%. Sounds messy.
Yeah, reports mentioned a huge drop.
Yeah.
And conflicting stories, some people yelling scam, but the project founder blaming forced liquidations of leveraged positions by exchanges.
So someone got wiped out on leverage.
That's the founder's claim, reckless closures by exchanges. He said they're investigating. It's a reminder of the extreme volatility and risks out there, especially with leverage.
Though apparently, even after that crash, it might still be beating Ethereum year to date from the start of 2024. Just shows how wild things can be.
It really does. Crazy swings.
Okay, so wrapping this all up, the big takeaway seems to be this clear dog whistle from the Fed, doesn't it? Signaling they might be ready to pivot if the bond market keeps acting up.
Absolutely. That signal, combined with everything else, the tariffs, the global uncertainty, the market reactions, it makes for a really dynamic, fast-moving situation. The potential implications for Bitcoin and really the whole financial system are pretty significant.
So maybe the final thought for everyone listening is this. With all these signals flying around the Fed, the bonds, the global shifts, what fundamental ideas about how money and markets work should you maybe reevaluate? What do you need to understand better to navigate whatever comes next? Definitely food for thought. Stay curious, stay informed.